Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to have with me Richard Staveley and Laurence Hulse of Gresham House Strategic. That's ticker GHS. Two of the smartest UK small cap fund managers with me. Morning, gents.
Morning.
Big congrats on the 5-year anniversary of the investment trust, and I noticed from the returns that the actual fund has beaten all major indices over that particular period. Can you just quickly sort of walk us through how you go about sort of stock picking, what your sort of investment process in your timescales, and perhaps just illustrate a couple with, make a few illustrations with the stocks in your portfolio at the moment?
Yeah, of course we can. That's no problem at all. So I guess the key thing about GHS is that it's very much an active fund. So we're targeting IRRs, or absolute returns of doubling people's money every 5 years. That's the mindset. You kindly referenced the first 5 years. It's fair to say we had some heavy lifting to do at the start period. Markets, bizarrely, because of COVID and Brexit, which seems such a long time ago now, mean that the small cap index is roughly up over those 5 years, just literally 2 to 3%. However, the fund's up about, in NAV terms, over 32%, and in share price terms, GHS is up about 40%. So what we have is a very concentrated and engaged approach. We take a much more active involvement in our investments than generalized, much more diversified small cap funds. In fact, at the moment, we've only got 14 equity positions in the fund itself. Team's been in place for a long time, but been evolving over the last year or so. And we focus in small cap, the best area for long-term returns. All the data shows it's just a fantastic space, and getting more and more interesting as more and more people race to global names and large cap and don't have the research to look at in small cap. So we think it's there's a structural overlooking of that part of the market which we want to address.
And with the concentrated portfolio, Richard, and you sort of talked about 14 current positions, what sort of size of holding of that company does Gresham take in order to influence the board?
Yeah, so we target between 5 and 25% of the company's share capital. That once you get to 5%, or you're a top 5 shareholder, they're going to have to listen to you. We then nuance how much we own depending on whether there are like-minded investors on the register that are trying to achieve the same kind of objectives as us, and we think understand shareholder value. And we might complement our weighting as well with proposing people to move onto the board, or getting involved with that to help increase our influence. Sometimes, and in fact, in a couple of positions more recently, we also earn a convertible loan as well as equity. And that means that we may not have quite as much equity, but we also have a lot of influence because we're in a bit of different part of the capital structure too.
And when do you decide to sell a position if it's been a home run? For instance, I know your largest holding is Augean, which has absolutely been a stormer over the last 3 years. You got that at the perfect sort of time, and but now it's sort of like it's over 25% of the fund itself, albeit it's got. I agree. It's got great opportunities going forward, and it still looks undervalued.
Yeah, it's a great question, and it's someone that does come up with us quite a bit. There are two different aspects to that. There's firstly the selling discipline, if anything, more important than buying discipline in our view, in terms of how to be a successful investor. And what drives our selling discipline is typically a combination of valuation, thesis playing out, so what we expected the company to do or to change or to improve actually occurring, thus the value drivers sort of finishing, or thirdly a transaction, something being taken over. We're not scared of having a much bigger position, and Augean would be a great example of where, frankly, most small cap fund managers would have been trimming and selling away much earlier on, and as a result wouldn't have got all the alpha that you could get out of that company. But what I'd actually like to do very briefly is reflect on another holding that we've had during these 5 years, a company called IMImobile. And IMImobile actually got up to 45% of the portfolio. It's fair to say that is seriously big for any fund manager, and it was for us as too. But we helped evolve the board, sort out their complicated shareholder structure. We got involved in their IR and advisors and things like that. When we originally bought it, it's on about 6 times EV/EBITDA. That re-rated to 12 times EBITDA. And we've actually managed to exit our entire position into the secondary market to other fund managers that now like the momentum, like the story, understand the business better. For Augean, we may do the same thing, but equally, Augean, we think is a very exciting strategic asset that could easily be approached by the much bigger companies in the sector, looking to become Augean are the market leader in hazardous waste, and there are waste companies with much more diverse operations.
I saw it with Augean that the valuation at the moment is roughly around about 5 or 6 times EBITDA, something around that. And then I believe that I think it was Viridor was sold by one of the water companies to, is it KKR about, I think it was 6 or 12 months ago. It was a difficult decision because it's clearly undervalued in the private market. So you don't want to sell at without taking some extra alpha, but equally, you don't want it to become so big that if you get a black swan event occurring to Augean, that it becomes an overpriced position. How do you manage that?
Yeah, it's again great question. So it's obviously a combination of judgment, but I would add what's helping that judgment is that with our process at Gresham House, we actually have an investment committee as well as us managing the fund. That investment committee's got some very experienced individuals on it, like Bruce Carnegie Brown, for instance, who's chairman of Lloyd's of London. We have Tom Teichman, who's a serial entrepreneur and really understands growth companies. It has Ken Wattenon, who runs the very top performing, in fact, microcap fund in the UK. It's an OIG. And those kind of decisions get discussed, or what we're doing with that, what risks we have at those meetings, as well as us making that judgment. Now, for Augean itself, there's 2 issues, exactly as you say. We don't want to be selling it even now if it's going to double in value. But do we really want it to get up to 50% of the fund? Probably not. So because of black swan capability. So actually, earlier this year, pre-COVID, we actually took the weighting down from 30% to 25% of the fund at a really nice level before the COVID kicked off in terms of markets. And I think it's fair to say we will manage the position carefully, assuming there is a demand in the market around that, so the current position size. In terms of valuing Augean, now it's great that you've noticed the Viridor transaction, because we don't feel enough people have looked at what these types of businesses can achieve. Now, Augean versus Viridor, it's not like for like. Our view is that industry multiples go for about between bottom end about 8 times up to about 12 times where the Viridor went. So we would say that we'd be foolish to be trimming it now back down at these levels, and we think we'll get an exit much more in that range I've just described.
Okay.
The thing about Augean, the only thing I would say is that regarding kind of the black swan, I hope these aren't famous last words, but Augean, it's in the waste market. Bizarrely, they actually benefit from the fact that more waste is now at home rather than in the office. It's the waste streams that have gone from your pret-a-manger to being in the bins outside. They actually benefit from that volume switch.
From the incinerators, basically.
Exactly.
The fly ash, yeah.
And the fly ash of those incinerators is coming on more. There's a structural growth in the creation of that ash, which has been what's been beneficial for them. Equally, their radioactive licensing they have is, it's non-cyclical per se. There's some disruption to that industry, but and the balance sheet is in great shape. I mean, they are generating huge amounts of net cash. Now, it's got an embedded option in at the moment, which your listeners might be interested in is that they got themselves in a real pickle with HMRC came in and said that they'd been not paying the right amounts of waste tax. Now, we did a huge amount of DD around this very early on when we got involved and felt the market was pricing in a worst case scenario, and more worse than the worst case scenario, but also they're in pretty strong position legally about what they've been paying. So that risk was paid off into escrow essentially at the back end of last year, which has created this big recent run in Augean. It just got onto the radar screens of normal small cap managers who are going, "What's this Augean? Oh, it's a market leader," and now it's on. And essentially they were just starting to do that, and then COVID hit, and everyone's gone, "Oh, I'll just focus on my own portfolio for now."
Okay.
So we've got the case will come up in the next 12 months. Now they will come to some resolution. If they win that case, the amount that they've put into escrow, it can only be upside essentially now where you get money in. Basically.
Yeah, £40 million. Yeah. Can I be a bit cheeky now? And I mean, you've got some very other interesting stocks in your portfolio. What are the next Augean and IMImobile? I mean, I noticed you've got Pressure Technologies in there. You've recently bought I can't remember which one it was, VANL, and you've also got ULS Technology. What are the next sort of IMImobiles, do you think, and Augeans? I mean, those are your seeds. You've had a couple of lovely blooming flowers, and now, like, which ones are the next ones that investors may want to run the slider all over?
Gosh, that is definitely a cheeky question. It's fair to say, and you could argue, I'll always say this, but for a small cap fund where we've only got 14 holdings, we're pretty much everything we're excited about. So in that regard. Now, what I'll maybe pass over to Laurie for a sec, who might, for instance, I think if you explain maybe the Pressure Tech situation and make sure you reference what's going on about hydrogen, and we explain what might happen with that company and what we've been doing with it as well.
So Pressure Technologies was a company that went on an M&A spree in the last oil and gas cycle that didn't work out to plan, which left the shares in a really interesting valuation for sort of value investors like ourselves. The business has two divisions, as the oil and gas division, and then a high pressure cylinders division, which is exposed to its core business is naval work with really good earnings visibility, long-term work on the Dreadnought program, which is the new Trident replacement, but also an emerging, really exciting opportunity in hydrogen. So we'd been monitoring the shares for some time. We saw a new chief executive went in. He came in to present to us. We really bought into his strategy to improve the operational culture and strategy of the business to try and capture that hydrogen opportunity and major on the naval work. So we took actually a 20% stake in the company with the view of supporting the company in strategic change to capture the emerging opportunity in building these sort of 40-foot long hydrogen storage tanks that go underground in sort of new future hydrogen refueling stations.
And Laurence, just on those, I mean, I remember from my GKN days, it is extremely difficult to manufacture this size of cylinder, which is like ultra precise in such massive scale. And that's a huge differentiator, I understand.
Correct. They're only one of actually two companies in the UK that can build cylinders like this. The cylinders division itself is actually a 200-year-old company. So loads of British industrial heritage, now capturing the next wave of industrial sort of revolution, really.
And then I would add here, Paul, just that the nature of how these guys are positioning is they've actually signed a contract. It's been announced. They've signed a contract with Shell. And this is obviously an area which is accelerating. Investors are starting to pick up that it's a growth area. Then we can see the amount of money going into ESG and kind of decarbonisation of the economy. What we're talking about here is that probably in commercial vehicles first, but the scope to have essentially large cylinders with hydrogen storage kind of all over the place. America, Shell obviously don't just have operations in Europe. These guys could become a kind of key key partner for them. But at the same time, what kind of a partner are they? They're guys that make the canisters that are massive for our nuclear submarines. So clearly, they're sort of they're not some tin pot players here. We're talking some real expertise. So.
And how much upside do you see? I mean, I think the shares are currently trading at about 90p, low 90s, and I can't remember what the market cap was. It 30 mil or something like that.
As Richard said at the start, we sort of target at least sort of 2 times over 5 years for our investors and our fund, and we're hoping with this one, if they can really capture the hydrogen opportunity, it should actually exceed that sort of minimum hurdle return level, but by a decent margin. All I would add on Precious Tech, we were able to, as part of our engaged, active investment philosophy, we're actually able to recommend a new chairman as and when the incumbent retired. So Sir Roy Gardner joined the board about sort of 6 months ago now as chairman, and really there to help provide sort of pearls of wisdom and help drive the strategic change for the next life of the business.
And then another one I saw you invest in, which was really sort of like piqued my interest, and you put I think the new chairman in was VANL, is that right? Or it was like you bought it a sort of 25p into the placing, and with the upside. What do you see on that? I mean, I've spoken to the guys as well, and they're going through a restructuring, and it seems to be a very interesting upside opportunity, particularly when HS2 comes through.
Yeah, well, HS2, is coming through, and I think this is the thing again with this. So this is it's a classic company that is being
piling, doesn't it? Piling and general
piling and foundation. So when you build anything from, interestingly, Amazon warehouses, which are a client of theirs, through to significant pieces of residential buildings. They are plugged in a bit into housing, through to whether the market leader, which is rail, which is as much as the foundations for the going up to the bridges, up to the tunnels and all the rest of it. They have specialist kit that they will, and teams, and they will deliver services and rent the equipment to the end contractors. The prior founders essentially almost overinvested, got over-focused on growth, poorly guided the market, and post-IPO, and a range of disappointments essentially. And we've been sort of tracking it, and as a result, everyone was giving up. They're still brokers with Peel Hunt, who, if you look at Peel Hunt's client deck, are actually now on average 10 times the size of VANL. So it might not be quite even sort of front of center of the guys' there's minds. The business had been left with a weak financial position, and basically we had identified this pre-COVID, and we'd started buying a bit of a position, knowing that they would need money, and then to ramp up. We then, when COVID hit, they definitely needed money and relatively quick. So we were actually able to price that deal essentially, in conjunction with the advisors and other shareholders. But as the marginal new significant buyer, we were able to say what level we wanted to, we would price it at. So, which was a significant discount to the book value of this kit. Now, we were fortunate enough in that we went up and did site DD in was it February, Laura? It was
February, yeah.
Hell, anyway, the day it was awful. But the amount they have, the kit is so well invested. This company doesn't really need to spend almost anything on capex going forward. What it needs to do is contract well with its existing kit and get utilization up and convert kit into cash flow. Yeah. Now that we expect to happen under this new management team. So the new CEO is ex-Balfour Beatty, very professional. He's they have had limited levels of KPIs. The oversight on capital decision making has not been as good as it should be. How they move kit about has lots of so he's seeing loads of operational things that should be able to get them back up to good margins. The company used to make 10% margins, and it's got a decent level of sales. Now, the thesis then is to use that raising to take a decent stake. The board is evolving into just got the. Frank from Galliford, who was the former finance director of Galliford Try, seasoned board member, and this ongoing change, I would say. So we're putting the right people around this new management team with a new FD as well. And basically, they should be able to rebuild margins, accelerate cash flow generation, and then go on to do. So they've got quite a few strategic options actually left. So they have this business doing geotechnical services, which is more kind of white collar alongside their standard business, and they could do bolt-on acquisitions in there. It's higher value earning streams. Investors like that kind of thing more than they do kit businesses. Equally, the actual piling market in the UK is not very well consolidated. So there are bigger picture opportunities for them on a 3 to 5 and onwards view. So we see this thing being able to generate a good return on its kit, which would suggest the price to book above 1 times. We see growth, and I think just to come back to where we started, the in HS2 has been signed off. I mean, given all the news flow on HS2 in the previous 3 years, and during COVID, it's basically had about 2 column inches since it's actually been signed off. I mean, they're letting projects. Balfour Beatty talking about it in their results recently. Yeah. It's going to happen, and they're so well positioned to pick up. Now, the only thing nuance I would say there is that CP6, which is the next phase of infrastructure spending, is also very big for these guys. And the key with kit, as my final point, is that it's not just your kit at an industry level, which helps you price. It's everybody else, how much kit they've got. What HS2 is going to do, it's going to suck in industry kit, which then basically makes it a better position for winning, what pricing you price on all the rest of the jobs around the country.
Supply and demand, basically.
So that's basically what we think. And they've had it's fair to say that the existing management, when they came in, they've had lots internally, but the pre-election environment was actually pretty tricky for this company. Not much infrastructure spending. Boris now clearly saying he's going to do a lot more. The housing market was dicky because of political uncertainty. I read this morning that Rightmove is saying last month 39 billion of agreed housing sales. It's the highest number of agreed housing sales in a month for 10 years.
No, I agree. Yeah.
So we think there's this sort of tsunami of demand, but loads of self-help, and that's kind of the thesis.
Yeah, I would definitely strongly recommend investors have a look at Augean, Pressure Tech, and VANL, because I totally agree they look great value. Just briefly, 3 others to talk about would be Fulcrum Utility, Flowtech, and if you do have sort of time, USL Technology. I mean, just very briefly, what you see in those, because they're sort of like different parts of the same sort of pie in building, but at different aspects.
Yeah. Laurie, why don't you do Fulcrum and then I'll do ULS? Yeah.
So Fulcrum's a really nice, simple risk-reward sum of the parts thesis. There's 2 key components to Fulcrum. There's the operating company that designs and digs utility connections, which is the sort of last mile gas, electric, fibre into housing and industrial sites, and increasingly electric vehicle charging points too. The other side of the business actually adopts some of these connections as an asset, because in a low interest rate environment, they pay a really attractive, highly consistent 10% yield, which is growing increasingly of interest to PE and infra funds because of that coupon. We started building a position in the company sort of pre-Christmas, pre-COVID, and accelerated that to a core position during the COVID volatility. But the thesis here is quite simple. The utility assets themselves, we think, should appreciate in value as infrastructure and private equity investor interest grows. We think they could be worth 35 to 40 million in 5 years' time. You've then got an operating company whose EBITDA, we think, under the new management team, especially the new COO, Terry Dugdale, we think that could be a 12 million plus EBITDA business on a 5-year view as well, that with its net zero focus could attract ESG interest, and therefore those earnings should trade on sort of 7 times. If you add the expected value of the book of assets of 35 to 40 and put that 12 million EBITDA on 7 times, you get a sort of 120 to 130 million value versus a market cap today of about 60, 65. And that, in a nutshell, is where we see ourselves doubling our money on Fulcrum.
And I saw Chris Mills also sort of tried to bid in, didn't he, at about 26p?
Just absolutely, I think we may have been competing for buy stock with him for a while now.
Yeah,
but, he's a great investor, so we don't mind. We often think alike about where the value is in small caps. So
yeah, with was it Flowtech? I see you've put in the new chairman, which is Roger McDowell. Yeah, a sort of real heavy hitter who came from Augean.
Yeah, he's there, and he's on a number of small cap listed stocks. He's a proven businessman. He really understands shareholder value. He often buys stock himself in a reasonable size, and he knows how to run boards, get the best out of management teams, and knows what drives shareholder value. I think what's particularly interesting about him being involved in Flowtech is that his original I don't profess to know his whole CV off by heart, but one of his biggest things that's worked for him personally was a business that he built up pre-going Plural, which was in distribution. And Flowtech is a distribution business, so he's got real domain understanding for Flowtech as well, which is definitely interesting. It's a distribution, again, same sort of focus for us. Very high levels of free cash flow generation. You just have to manage that stock perfectly, deliver good service, just go like this, and all that stock just churns into cash, which goes to essentially shareholders. Still very fragmented industry, so there's a lot more acquisitions they could do to build up, and then private equity are building. It's a funny word, but behemoths basically in this space, like much bigger bit, which they could eventually, which we would expect Flowtech to eventually kind of become part of. The business, again, loads of sales, constant good levels of cash generation, but the market, it's sub 100. No one really cares. So it's great.
Just coming back to your comment on from Rightmove with a blockbuster July transactions of 39 billion. I mean, that must play to the ULS technology side, because being the number one sort of software conveyancer, is that right? Is that the thesis?
They're going to have to justify themselves if they come in and say things have been going poorly at the next meeting. I can tell you that. I mean, so this business, I mean, it's great because we've got a value bias and we want a good margin of safety. In recent years, tech has been consistently re-rated, and it's difficult for us to find things where we're really comfortable about where we're in. Now, ULS turned out to be the opposite, in that they had a change in management a couple of years ago, and the previous guy was sold the stock very strongly to the market and was very enigmatic. And essentially, there's been a rotation of shareholders, and people sort of lost interest in it. The business, though, has it's basically a platform business. Now, I'm sure you and your listeners will know that platform businesses are now the thing that everyone wants to be. You create a platform that marries two sides of a transaction and essentially make life easier for them. And then once you pass the point of enough transactions going through it, you just make a fortune. So ULS is actually already making a fortune. Its sales are late 20 million, 25 million, roughly like that.
It's a number one.
Underlying, it made 6 million EBITDA last year. So it's very profitable. Now, the point, what's happened is they chose to reinvest a decent chunk of that profit into this new product development they've got, which is called Digital Move. And we think that has the capability to, on a medium-term basis, both accelerate the growth rate and their market share, which is still only 3%. So what Digital Move does is it speeds up the conveyancing process for buying and selling a house, and indeed the remortgaging process as well. They have a fast remortgaging process, and all you're doing is they're linking up lawyers that want it to use up as least time as possible for the same price that they charge, estate agents or mortgage brokers that just want to get their commission in as quickly as possible without the faff, and the consumer that just wants to move quickly, without all the sort of faff. And Digital Move takes out what was laboriously, I know on my last house move a number of years ago, it was just terrible. There's the papers going backwards and forwards and all that. So this Digital Move product, they spent a lot of money trying to optimize. embed them in these networks of lawyers and estate agents and mortgage brokers. And then the transaction volumes just need to pick up, and they just keep clipping. What's amazing is with those sales numbers I mentioned earlier, the typical average conveyancing, it's about 380 quid. And they make they make 100 to 150 million quid per transaction out of it, roughly that. So they are already making loads. Now, what I also like about it is the value of housing. So like housing, if you're sort of bearish on the outlook for housing prices, which quite understandably quite a lot of people would be, and in fact I would be, no bull of housing prices, is that it's actually just transactions. So they're unlike a house builder. You want the pricing of housing to keep going up, but these guys aren't that fussed about it. They just need people unlocked and moving more, which is essentially what the government wants. We don't want a turgid, sticky. We want people to be able to mobilise, move around the country, move out of their houses, the wrong accommodation for them, and these companies essentially helps take the friction out of that industry.
Yeah, well, I'm just going to ask you a final sort of like cheeky question here, because you've got a lot of sort of opportunities to invest. Would the fund ever consider raising more money to allow more investors on board? Because it's about sort of 45 million market cap, and clearly you've got an absolute bucket of potential investment opportunities. Or would that dilute the returns that people would get? I mean, how would you ever view that?
So the short answer to that, it's not cheeky, it's the right question to ask. We would love to be running more money, but you're absolutely right to identify one of the biggest things that's meant that fund managers have underperformed for consumers in this country and savers in this country is that they've allowed themselves to run too much money. And I'm not going to do names, but you can look through the history books, and it's people too much money for what they can deploy. Now, we believe we can run up to about 350 million in this type of approach for companies under 250 million market cap. We're obviously miles less than that. At that point, we would probably then spend some time just making sure that we could deploy and rotate appropriately. And then there is a bit of discussion with this, it's fair to say, within the team. We could probably do a little bit more than that. So raising money specifically for GHS, as you'll be aware, in the closed-end market is existing shareholders get very uncomfortable with the issuance of stock at a discount to NAV. If we were trading at NAV tomorrow, we would all be up for the board, the manager. We would love to try and raise more money from shareholders if that was the case, but we're not. And I would sort of finish on that now, is that we've actually been growing the NAV quite nicely during the last few months, but possibly like some of our stocks, the market's focus is elsewhere, and as a result, the discount's actually widened out. We're at about 17.5% currently discount. So all those stocks we've just mentioned, we're a buyer of GHS shares right now is buying at a 17.5% discount to, we've got a load of cash we're about to deploy and some really exciting things we'll have to talk to you about on the next call, but also Augean. So the valuation Augean's cheap on, you're getting it at a 17.5% discount to Augean, which is a quarter of the fund. So I guess the point is that we'd like to see, when hopefully people will see that as an opportunity, we can get sufficient buyers momentum to get this up to near as damn at NAV, and then we'd love to grow the trust if we could.
Okay, brilliant. Well, many thanks, guys, for your time. Really fascinating, and yes, we look forward to chatting to you going forward. In the event that investors would like to contact you and sort of like put some money into the funds, what is the best way? Is it best through the website, is it, or something like that? Or
yeah, the website has a lot of information. It's got our latest presentation, which lots of fund managers don't put on, but we do it monthly or quarterly. So there's pretty much a new one on there, the fact sheet and things like that. And then we would urge them to go through their financial advisors or their platforms. But GHS is daily tradable. In fact, if you look on the RNSs, I bought some shares a week ago in GHS, so added to my own holdings. So we're happy to take calls if people want to speak to us. Just call into Gresham, and you'll be forwarded on. You'll come straight up through to us.
Brilliant, guys. Thanks very much.
Thanks,
okay,
Paul.
brilliant.